Ladies and gentlemen, good day and welcome to the earnings conference call of Dalmia Bharat Limited for the quarter ended 30th June 2023. Please note that this conference call will be for 60 minutes, and for the duration of this conference call, all participant lines will be in the listen-only mode. This conference call is being recorded and the transcript may be put on the website of the company. After the management discussion, there is an opportunity for you to ask questions. Should anyone need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. As a reminder, all participant lines will be in the listen-only mode. Before I hand over the conference to the management, I would like to remind you that certain statements made during the course of this call may not be based on historical information or facts and may be forward-looking statements. These statements are based on expectations and projections and may involve a number of risks and uncertainties such that the actual outcome may differ materially from those suggested by such statements. On the call, we have with us Mr. Puneet Dalmia, Managing Director, Dalmia Bharat Limited, Mr. Mahendra Singhi, Managing Director and CEO, Dalmia Cement Bharat Limited, Mr. Dharmendra Tuteja, CFO, Dalmia Bharat Limited, Mr. Rajiv Bansal, President and Chief Transformation Officer, and the other management of the company. I would now like to hand the conference call over to Ms. Aditi Mittal, Head, Investor Relations. Thank you, and over to you.
Good morning, everybody. Welcome to the Quarter 1 earnings call of Dalmia Bharat Limited. I also wanted to let you know that the earnings release has been uploaded on our website today morning. So in case you've not had a chance to look at it, you can download it from our website. With this, I'll hand over the call to Mr. Dalmia for his opening remarks. Thank you.
Thank you, Aditi. Good morning, everyone. It gives me immense pleasure to welcome all of you to the Q1 FY24 earnings call of Dalmia Bharat Limited. Let me briefly share my outlook with you, and after which Mr. Singhi and Dharmender will give you more details about our performance. As I've been sharing with you over the last few quarters, the economic environment in our country has been resilient. Our sector is doing well, with the cement demand being robust, and the cost curve is moving in a favorable direction. But this quarter, the operating performance of our company has been below my expectations. We are introspecting and working diligently to implement improvements. During the quarter, our sales volume has grown 12% on a YOY basis, but we believe that we could have done much better. And while we remain one of the lowest total cost producers of cement in the industry, I also believe that there's a lot more headroom to improvise on the cost front as well. So this quarter has been a learning for us in terms of performance, and we will take it up very seriously amongst ourselves. On the capacity growth front, we have delivered on the committed expansion numbers and added 3.1 million ton in East during the quarter. We have commenced the trial run production at the Satur plant in Tamil Nadu, which adds another 2 million tons to our capacity. We are on track to complete the organic expansion target of cement capacity and reach 46.6 million tons by March 2024. With regards to the acquisition of JP in the central region, I would like to share with you that we are awaiting certain external approvals which are taking slightly longer time than we had originally anticipated. And considering the external exigencies, we will try and close the transaction before the end of this financial year. Nevertheless, we will keep you posted in the interim for updates with regard to the same. This excludes the JP Super Dalla tranche, which is entirely dependent upon the outcome of arbitration between UltraTech and JP. As was mentioned by Singhi ji during our last earnings call, we have started the tolling arrangement from some of the plant locations of JP in central region so that we do not lose time and make some headway into building the Dalmia brand in the region. We have started empaneling dealers, and this also gives us an opportunity to gradually establish our market share in the region. On the overall cement industry outlook, the demand growth looks robust, prices remain range-bound, and costs are coming down in line with the fall in fuel prices. The cost will further show a positive delta due to the implementation of our ongoing levers of long-term cost savings such as renewable power, low carbon cement, and recycled fuel amongst others. With this, I would like to hand over the call to Mr. Singhi for his opening remarks. Thank you.
Thanks, Punitji. Happy morning, friends. As Punitji has mentioned, the cement demand in the country is growing at a very healthy rate. For Q1, we do expect that the demand on all India basis may be between 8 to 10%. During the quarter, we delivered a volume growth of 12% on YOY basis to 7 billion ton. This growth was visible across regions. The performance in South region was better and continues to be encouraging, where we have been strengthening our market share over the last couple of years. In fact, our low carbon cement percentage is also growing in South at a healthy rate, with last quarter being at 75%. For the company as a whole, our low carbon cement percentage for the quarter has gone up to 88%. Revenues for the quarter improved by 10% YOY to rupees 3,624 crores, led by volume growth, but adversely impacted by lower prices. From the exit prices of June 23, prices to some extent has weakened as the seasonal factors have started to settle. In terms of the cost, our raw material cost has increased by around 9% on a YOY basis to rupees 768 rupees per ton of cement production, which is primarily due to increase in rates of slag and fly ash and some transportation costs, which has gone up by almost 20% and 9% respectively. The purchase of stock in trade goods has shown an increase during the quarter, as this line item captures the cost of cement purchased, which is being manufactured under the agreement with JP, and that cost too is coming in is at a rate which is slightly higher than our existing cost of production. Coming to the power and fuel costs, during the quarter, our power and fuel cost has marginally increased by 1% on QOQ basis to rupees 1,293 per ton of cement production. As mentioned in the previous earnings call, our fuel cost has realized the benefit of around $10 per ton of petcoke reduction during the quarter. However, it may not be visible on a sequential basis due to increase in power rates in few of the states where the fuel surcharge has gone up. As well, we had to also go for grid power in place of CPP power, because the CPP power became expensive at that time on account of higher fuel rates. There has been also the change in CC ratio, which is driven by change in the regional mix. To give you some color on the ongoing fuel prices, the current spot rates are now hovering around $115, and the benefit from such reduction should start reflecting from the mid of quarter 3. With the reduction in the fuel costs, now our CPPs will also become viable, and we are now able to switch to our captive power plant from the grid power. We will also see the benefit of this in coming quarters. With regards to the freight cost, the cost has increased by 6% on YOY basis to rupees 1,156 per ton, primarily due to levy of busy season surcharge by railways and some interregional clinker movement because of some plant stoppages. Friends, our EBITDA per ton during the quarter has come to rupees 872 per ton. On the growth side, while our CFO Dalmia will give you the detailed update on capex and cash outflow, I would like to update that during the quarter, we have commercialized the new cement line at Bokaro, Jharkhand of 2.5 million ton, and also successfully debottlenecked our facility at Bengal by 0.6 million ton, which took our East region capacity to 21.1 million tons and overall capacity to 41.7 million tons. As Punitji has already mentioned, we have also commenced the trial run at our 2 million ton grinding plant at Satur in Tamil Nadu, which was a greenfield split grinding unit project of the company. With regard to proposed growth in Northeast, we have received the necessary state of approvals and have mobilized the civil contractors and have also placed major orders with top technology suppliers for the equipment. We are targeting to complete this project by FY23-24. During the quarter, our RE capacity has increased to 170 megawatts, which is 10 times of the capacity we had in FY19. Friends, for the rest of the details and the key financial updates, I would now like to hand over the call to our CFO, Sri Dharmendra, and I will also be happy to answer all questions in the Q&A following his remarks. Thank you and best wishes.
Thank you, Sri. Good morning, everyone. Let me quickly get into the key financial updates before we open the floor for Q&A. With regards to the incentives, we have accrued rupees 77 crores of incentives during the quarter. The collection during the quarter has been rupees 39 crores. The average receivable on this account as on 30th June stood at rupees 740 crores. For FY24, we expect incentive accruals to be around 275 to 300 crores. Moving to the fixed costs, our employee costs have increased by rupees 24 crores to rupees 222 crores on a YOY basis, primarily due to annual increments and increase in number of headcounts on account of adding new capacity at different locations. Other expenses have increased by rupees 51 crores to rupees 515 crores on a YOY basis, primarily on account of plant shutdown costs, increase in depot expenses, and sales commission increase. Our depreciation during the quarter has increased by rupees 87 crores on a YOY basis. Let me explain to you why is that. See, as part of our overall debottlenecking project to increase cement and clinker capacities, certain components of plant and equipments will be replaced. Accordingly, an accelerated depreciation of rupees 57 crore has been charged on these components during this quarter. This is basically a one-off expense with another about rupees 54 crores of charge to be taken on this account in the next 2 quarters. Excluding this one-time write-off or charge, the regular annual depreciation for the year will be higher by about 120 to 150 crores on account of recently added capacity and new capacity to be further capitalized during the rest of the year. On the debt side, our gross debt has increased by 623 crores and the closing gross debt as on 30th June stood at 4,386 crores. The net debt to EBITDA ratio as on 30th June was 0.52 times. With regard to the capital expenditure, we have spent rupees 907 crores during the quarter. As mentioned by Singhi, we have closed this quarter with the capacity of about 41.7 million tons and have recently commenced the trial production at the new split grinding unit at Satur in Tamil Nadu. Within the next 1 to 2 months, we expect to commence the commercial production of this unit also. For the full year, we expect the capex to be about 6,300 crores, including acquisition of JP plants. With regard to the recent divestment of the non-core businesses, as you'll remember, the company had entered into a binding agreement to divest its equity stake in the refractory company at a consideration of rupees 800 crores. With regard to the same, out of total receivable, 20%, that is 160 crore, has been received in this quarter as part of the transaction, and for the rest of 80% consideration, NCDs have been allotted to DCBL. These debentures will be redeemed in 2 equal tranches, with the first one to be redeemed in December 23 and the remaining 40% will be redeemed in September 24. Besides this, they will also be receiving the 120 crores which is due from the redemption of debentures of Hippo stores at December 23. With this, I now open the floor for question and answer. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Indrajit from CLSA. Please go ahead.
Hi, good morning. Thank you for the opportunity. Can you help us understand the cement tooling operations with JP once again? What was the volume? What kind of revenue we have generated? And is it sold under Dalmia brand itself?
So this is Puneet. We have a tolling arrangement currently with JP where they are contract manufacturing cement for us and we are selling it under the Dalmia brand. So we are setting up our distribution, we are establishing our brand, but the manufacturing is currently being done by JP. So I think this gives us a headroom in the market to establish ourselves before the acquisition is completed. Because as you know, this is a new market for us. And we are in the process of establishing the distribution network, establishing the brand, and establishing the full logistics infrastructure to service the market. So I think, broadly, that is the arrangement, and I think it is, helpful for us that, we can do this even before the deal gets done.
And what is the kind of volumes we have done and any outlook for the year as a whole? How much we can do?
So we are not sharing our regional numbers. Right now we share numbers on an aggregated basis. But all I can say is that, this will help us ramp up this capacity faster compared to if we would not have done tolling.
Sure. And secondly, in the opening remarks, sir, you mentioned you could have grown faster barring some issues. So if you can elaborate on it, what were those issues and are those now behind us? And have we lost market shares as a result of those issues?
Yes. So I think we did a experiment in Eastern India to improve, price discipline amongst our dealers. And I think it has, not worked to the extent that we wanted it to. And we have, learnings from this experiment. We have definitely lost market share in that region. And I think it will take us, some time to correct it, but we are very clear about what we have to do. And in the, during the year, I think we are definitely going to take corrective measures, and I'm absolutely confident that we are going to see a rebound in our volumes to the expectations that we have.
So, is it fair to assume that led to the decline in CC ratio?
Yes, absolutely, because our regional mix changed.
Did that have any impact on the power cost as well? Sorry, that's my last question. Because of the mix.
Ingiji, can you answer that? I just want to say one more thing since we discussed East. I think our performance in South and Northeast has been exceptional. We are very happy with the, growth there. On all parameters, whether it is our trade mix, whether it is our premium product mix, whether it is our, YY growth, I think it is, really, very encouraging. I think there's one region that we have to, focus more on, which is East. And, all hands on deck, we are completely focused on it. So, Singhji, over to you on the power cost.
Yes, please. So, on power and fuel, because of the change and lower CC ratio, yes, it has affected to some extent. And on that account, power and fuel cost is seeing a higher number.
Sure. Thank you so much for your answers. I'll join back the queue.
Thank you. We have our next question from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir. Good morning. This question pertains to this incentive which I announced that you have won again from Supreme Court regarding the West Bengal incentives. So, would you suggest if this plant is still accruing an incentive in your total numbers?
Now this incentive period has already expired. It is the pending amount which was due, for which Honorable High Court has given orders to pay this amount to us.
Okay. So you have, is there any other incentives or approval which is happening from West Bengal government?
No, please.
Not at this place, okay. And coming to this JPA, tolling arrangement, out of this, purchased of traded goods number for last 2 quarters, 46 crore and 96 crores. Do they pertain mostly to the JPA, or are there other products also which you are reflecting in purchase of goods?
It is only from JP, please.
Okay, from JPA. And coming on the fuel cost, could you share on a per kilocal what was the average costing in Q1 and how was it in Q4?
Yes. So it was per kilocalorie, it was 1.98, and last quarter it was 2.06.
Okay, 2.06 or 1. And how are these numbers looking at the current spot price basis?
So we expect that yes, during this quarter there should be benefit of $20 on petcoke basis, and in future also maybe around $5 to $15.
Okay, so on a quarter-on-quarter basis, you're looking at a fall of $20.
Yes.
So around 15% savings is what could get reflected.
Yes.
Okay. And this freight cost also, is there any one-off in this quarter, and hence we would see that normalization, or the current freight cost would be a more normalized number?
One on the rate increase, which is on account of busy season surcharge by railways, that is still continuing, though normally they used to discontinue in rainy season, but this time it is continuing. So from that point of view, this cost will be there. But then whatever some extra cost which we have incurred on some inter-regional movement of clinker, that will come down.
Okay. And lastly, on the depreciation part, which DT sir was explaining, I missed it. This quarter, there is an 57 crore additional because of the accelerated depreciation on kilns or plants, equipments which you are replacing.
Yes.
And similar number you are looking at each of Q2 and Q3?
Not similar number. The total 54 crores should come in the next 2 quarters.
Okay.
About 40 in Q2, another 14 in Q3.
Okay, understood. And thereafter it will
Sir, I
be
request you to join back the queue, Mr. Ravi, for follow-up question.
Sure. Yeah, that's all from my end for now. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer queries from all participants, please restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We'll take our next question from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi, thanks for the opportunity. So just on JP again, so you are not sending clinker to them for grinding, right? Just buying cement straight from them and selling it in the market, just to clarify.
Yes, please.
Okay. So the inter-unit clinker freight that has increased, so that would be on account of what reason then?
Mainly it comes when one unit which is under shutdown because of either debottlenecking or otherwise, and if there is a some shortage of cement clinker, then from one unit to other unit this clinker is being sent so that we can continue to serve that market.
So that's temporary only then, right?
So yes, and sometimes because of some rake shortage in the area.
Okay. And JPA deal completion by March 24 is for entire 9.4 million tons or the 5.2 million tons, the first phase 1?
As Gundiji has highlighted that yes, other than the JP Super which is under arbitration, the rest would come.
Right. And I just had one more question on the Northeast expansion. So it's coming in FY26, but I was just looking through the numbers. So you seem to have 5.8 million ton capacity in Northeast, and broadly the volume would be like closer to 2.5, 2.6 million tons. So, like, is there any need to expand right away, given that it's almost like a 50% or lower utilization right now?
Yes, like Northeast, if you look at GDP growth of Assam state itself, then that is going more than, I think, 15% or so. As well, the demand which is expected in Northeast of cement, it may also be around 20-25%. So one, to have and capture the market in right time, we are preparing ourselves for the capacity so that we can capture more market share. And this is a good market to be with ready to be with the capacity.
Right. So the expectation is for 2020.
Mr. Murarka, I request you to join back the queue, sir.
Sure. Thank you. Yeah.
Thank you. We have our next question from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good morning and thanks for the chance. The first question, just continuing on this JP acquisition, is it a delay in both the tranches? I mean, the initial 5.2, 5.4 and the next one. And do we see any risk in the entire deal because of these delays, or these are just purely regulatory delays and eventually we are confident of closing the acquisition?
I think these are regulatory delays. It takes time for us to get approvals from banks and the various authorities which are internal to them. They have to, do a lot of compliance-related stuff. And I think we are quite confident that, we should be able to, get this done during this financial year. But, a little bit of delay here and there because of, how the process works cannot be ruled out. But it doesn't risk the deal itself.
Okay, got that. So second question is with respect to our FY27 target of 75 million tons. Is it possible to share some more color from 55 to 75 journey? What could be the potential mix of greenfield, brownfield, inorganic, and any new regions will be seeing some entry?
Rajiv, do you want to take that?
Sumangal, at this point of time, we are still drilling it out. So at this point of time, unfortunately, we are not able to give any color.
No worries. And just one last clarification. I mean, overall, if you see last few years, we've cleaned up most of our non-core assets. So there is still one or two quoted investments in our balance sheet. So any timeline towards divesting journey of these non-core assets?
On the IX also, as we have said in the past, this will remain a non-core and will get divested. Of course, we cannot give the timeline, but should happen sooner than people may expect.
Got that. Thank you and all the best.
Thank you.
Thank you. We have our next question from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Thank you very much. My first question is...
Sir, you're not clearly audible. Can you use your handset, please?
Yeah, my first question is going back to Puneet's comments on the loss of market share in Eastern India. And Dalmia's volume growth at 12.4% is materially lower than some of the industry leaders that we have seen. Going forward, how do we plan to address this in terms of regaining the market share? Is the company willing to trade cement prices to regain market share, especially in Eastern India?
So we have taken certain steps as well as we have done certain restructuring in our marketing strategy also, as well as in our team also. And but definitely at the same time, we will not be compromising on prices.
Sure. So just to understand that historically Dalmia has grown sharply faster than the industry, will that trend continue, or given the preference of pricing over volume, Dalmia's volume growth should be more in line with industry volume growth going forward?
Yes, our growth for the whole year would be comparison to the leaders of the industry. So we would be definitely growing around, say, 15 to 17%.
Sure. And my last question is on leverage. So the gross debt over the last 1 year has gone from roughly 3,000 crores to 4,300 crores. We have the JPA acquisition which should come through. So what is the target debt for the exit March 24? How high will this number go?
This may touch close to about, I think, 6,500 to 7,000 crores, depending upon timing of the acquisition.
So this 7,500 crores would include the JPA related cost and the organic capex, whatever the company does, both of them.
That's everything.
Understood. Thank you very much.
Thank you. We have our next question from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. First question, follow up on the market share loss. Just want to clarify the strategy of maybe more discipline in dealers was tried in East. If I understand, has Dalmia lost some share in the other Tamil Nadu, Kerala markets as well, or is it mainly East for now? And what is the strategy to gain both market share without disrupting pricing discipline? That's the first question.
First, I would like to say that we have gained market share in South as well as in Northeast also. And in terms of East, we would not definitely again compromising on pricing front. And we have some strategy which definitely everything cannot be shared on this call.
Okay. So secondly, on taxes, the cash taxes for Dalmia have been low for the past few years. There's obviously all these assets, OCL and Murli. Just want to clarify, is there any other reason apart from this, maybe ATIA or any other incentive that also leads to lower cash taxes? And with JP also coming in would also bring some losses on its own. So maybe some clarity on the taxes for the next couple of years.
Yeah, the current quarter current tax rate is higher because of the recognition of the tax on the sale of DBRL shares, so about 50 crores. So this was already provided in March accounts as deferred tax liability, because when we kept this asset as a held for sale, so the deferred tax liability was created. So this quarter it moves to cash and reversal in the deferred tax liability. So on the whole, in the current year, the cash tax rate, apart from this sale of investments, should be around 10%. And in ATIA, in DCBL, we have not claimed the ATIA benefits because we were always in the losses due to the merger of the units and the losses arising out of the depreciation.
And tax losses from JP, any guidance or numbers?
Yeah, in the current year, of course, we'll have the advantage of the past profitable losses, which should continue partly in the next year also. Thereafter, we can presume to be normal tax rates.
Just one more quickly, if I can squeeze in on the recently grid power and CPP was more expensive, so switched to grid power. Was that also specific to certain regions, or was it across the regions that you saw that trend?
Mainly that was in South. So again now, because of softening of prices of South African coal or Indonesian coal, now CPP have become viable, and then we have reduced the power consumption of grid power, and CPP have now started.
Thank you so much.
Thank you. We have a next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Hello. Yeah, good morning, sir. My question is also on JPA transaction. So last quarter, we said that we are looking to complete this transaction by first quarter.
I'm sorry, you're not audible, sir. Please use your handset mode.
Hello, is it audible?
Yes.
Yeah, so my question is, last quarter we did say that we are looking to complete this transaction like in first quarter 24. And now we are talking about like completing by end of FY24. So I just wanted to understand what changed so much that we are delaying that deal closure timeline by like 9 months for this transaction?
There's a delay on the bank side. There are compliances that they have to do, and I think there are 35 banks involved. So it just, is taking some time to get that process in place.
Sorry, so these are like general delays, or there is a specific lender approval or some regulatory approval which is pending? Because last time I remember you saying like lender's approval was pending.
I think it is lender's approval.
Mr. Kumar?
I mean, while last quarter we were expecting some volumes to flow from this deal in this year, but what would be the volume expectation from this deal for like let's say FY25 from JPA overall 9 million ton?
I think let us come back to you on that as to how much we can do overall. I don't think we will share numbers on a region by region basis.
Okay. And I missed your capex for the current quarter and the FY24 outlook. Can you just repeat the same?
Can you repeat the question, please?
The capex number for current quarter and the full year expectation for FY24.
Yeah, full year will be about 6,300 crores, and current quarter should be also around 600 or so, 6 to 700.
900.
Previous quarter was 900. The quarter one.
Quarter one.
Yeah.
Right. Thank you.
Thank you. We have our next question from the line of Rashi Chopra from Citigroup. Please go ahead.
Thank you. Just on pricing, you indicated that the exit prices are weaker. Is that across regions?
Sorry?
You indicated that cement prices are weaker from the exit of June. Is that across all regions?
Mainly it's in east and in some part of south.
Okay. And are you expecting any sort of reversal? Because your press release says that you're expecting stable prices through the year. So from here on, what do you expect them to this trend to continue or some sort of an increase post the monsoon?
Post monsoon, it should be better.
Okay. Then on the cost side, just to be clear, you said that, this is the part I missed, that while your fuel consumption cost was actually lower, the benefit wasn't visible because of a lower CC ratio and you had some power rates go up in some states. Is that correct?
Yes.
Okay. And what was the lead distance during this quarter?
284 kilometers.
So the lead distance actually fell sequentially, but your freight cost got impacted because of the inter-unit clinker transfer.
Moment.
And
Sorry, and?
BG season surcharge.
Which was not there in the corresponding quarter last year.
No, I'm talking sequentially.
Yes, sequentially, it was not because of BG season surcharge.
Right. And last question for me, what was the proportion of trade volumes during the quarter?
63%.
63.
Yes.
Thank you.
Thank you. We have our next question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you. Sir, just to understand further in terms of the pricing, when we say it has weakened from the June, so broadly, if you can help us, whether it is 5 rupees per bag kind of a decline, and related to that, considering when we say a 15% kind of a power and fuel cost benefit to come in the 2Q, is it fair to assume that the Q2 FY24, that this quarter profitability on QOQ basis likely to be 100 rupees kind of improvement?
So one I would say on price front, yes, it's around 5 rupees, and that too in east and some part of south. Yes.
Okay.
And yes, there would be benefit on account of lower power and fuel cost.
So we mentioned a 15% kind of a benefit on QOQ. Is it fair to assume that the QOQ profitability to improve in the second quarter by a decent number?
No, we don't give any guidance on specific improvement in EBITDA or as.
Directionally, I'm not saying any specific, but directionally, this 872 rupees EBITDA. So when we say a 15% decline in power and fuel cost in Q2, so that should be a close to 240 rupees kind of a decline. So just trying to broadly understand the QOQ profitability to improve.
So naturally, it will be better. On quarter basis, naturally, it will be better.
Okay. I need a number on the CC ratio, railroad mix, and the premium set for this quarter.
So premium product has been 21% of total sales, and trade sale has been 63%.
Yeah, CC ratio and railroad mix.
One CC ratio 1.71.
Okay, and rail mix, railroad.
Road 84%.
84% road, 16% railway.
And broadly, the capex for FY25, if we look at the 6,300 crore this year, then the next year should be close to 3,500 odd crore for FY25.
Yeah, it should be around 3,000, 3,500. And balance, of course, depends on new announcements.
Yeah, definitely. But considering that when we say that our gross rate by end of FY24 likely to increase to 6,500 to 7,000, so does that are we not factoring the IX to dispose of currently? So without that, we are saying that our gross rate likely to increase to that.
So I will not specifically comment on that, whether it is including IX or excluding IX. Broadly, whatever guidance I give, I think we should be able to achieve it.
Okay. Thank you, sir. All the best.
Thank you.
Thank you. We have a next question from the line of Jashandeep Chadha from Nomura. Please go ahead.
Hi. Thank you for the opportunity. Am I audible?
Yes, please.
Yeah. Hi, sir. Just wanted to ask your view on the trade sale. We understand that you said your experiment of maintaining, price discipline is failed. So does that indicate that the trade sale or the demand from the trade segment is weaker than what, we were expecting? Because a lot demand push, dictates pricing. So if you are not able to maintain pricing there, it means that trade volumes are lower. And with erratic and unseasonal rainfall happening, that might continue, into the quarter 3 as well. Just wanted to understand your view on that.
Yeah. To some extent, yes. In eastern part, it had impact on our trade percentage. But as far as future is concerned and the post-monsoon is concerned, it would be better.
Okay. And sir, just related to that, you said you gain market share in the southern market. Just wanted to understand what portion of that incremental volume is to non-trade segment and, how much of the trade demand you saw in that. Directionally will do. I know you don't give specific numbers, but directionally will also do.
So mainly our trade percentage has gone up. Market share has gone up in trade market also.
Okay. And lastly, sir, can you please provide the breakup of 6,700 crore capex that you have guided for FY24? How much of that will be for, related to JP?
So up to about 3,500 crore or so, out of 6,300.
3,700 crore.
6,300.
About 3,500.
3,500. Okay. Thank you so much. I'll join the queue.
Thank you. We have our next question from the line of Vishal Biraya from Bandhan AMC. Please go ahead.
Yeah. Thank you for the opportunity.
Sir, we cannot hear you.
Am I audible now?
Sir, it is very low.
Okay, I'll try and speak a little louder. So, On the non-trade segment, could you give some perspective as to how have been the realizations and how has been the profitability in first quarter?
We don't share specific numbers.
No, agreed, but even at least qualitatively?
Qualitatively, non-trade prices were better. It had not fallen to that extent.
So non-trade prices would have been flattish quarter on quarter?
You are talking QOQ? Yes.
Okay. So your profitability in the non-trade segment would have been better than the trade segment. Would that be a fair understanding, at least for the southern region?
So, say like on QOQ basis, if you look at it was almost same in trade and non-trade.
Okay. Fair enough. Thank you.
Thank you. We have our next question from the line of Mudit Agarwal from Motilal Oswal Financial Services. Please go ahead.
Hello. Good morning, sir. So my question is related to the alternative fuel. So what is the current alternative fuel share and your thoughts how it will be improved going forward?
We don't share that data on a granular basis.
Hello? Am I audible, sir? Hello?
Yes.
We don't share this data on a granular basis.
On alternative fuels, sir.
Yeah.
Okay. Thank you.
Thank you. We have our next question from the line of Atharva Butaba from Purnartha Investment Advisors. Please go ahead.
So my question was that in the last phone call it was mentioned that CPC has been approved by NHI, and according to my research, PPC and OPC are the most used cement and construction activities. So according to the quarter 4 FY23 segment data that was given, we have only 60% revenue coming from these segments. So what are our plans to increase this in the near future?
Sorry, I could not get your question, please.
So PPC and OPC is only contributing 60% in segment revenue, right?
Yes.
So it is the most used cement in construction activities. Are we going to increase this in the near future?
In fact, now NHI and other various important projects in the country, they have also started using blended cement to low carbon cement on account of carbon awareness also. And at the same time, we are going to increase our share only in blended cement, in low carbon cement.
Okay. And there was some data that there was a pledge by Chandra Singhi. So why was this done? 1 lakh shares was pledged by Chandra Singhi. Why was this done?
Yes.
So why was this done?
So she must have the requirement of fund for some other purpose, and that's why.
Okay, so fund purpose. Okay. Thank you.
Thank you. We have our next question from the line of Naveen Sahdev from ICICI Securities. Please go ahead.
Yeah. Hello. Am I audible?
Yes, sir.
Yes.
Right. Good morning, and thank you for the opportunity. 2 questions. One, on the tolling arrangement with JPA. So is it fair to assume that, of course, you clarified that the deal will happen more towards end of the fiscal, but through the year, the volume intensity of that will only increase as we, create a dealer network and a brand presence there. So is it fair to assume that the volume intensity from JPA will only increase through the quarters, contributing to overall volume growth, even though the contribution at the EBITDA level, because of high cost of production or maybe a little low prices that we get in the market since we are a new entrant there, will be low, but volume contribution could intensify quarter on quarter?
Yes, volume will slowly will grow up.
Correct. So if you could have, it will really help, because in the current quarter, the 12% volume growth that also includes share from this tolling arrangement. So if you could have just given some indication that how much run rate roughly, because these assets initially were operating at very low utilizations of sub 20-25%. Some color on JPA volumes would really help here.
As we have highlighted earlier, it would be possible to share the separate number or region-wise number.
Sure. My last question was about the southern markets. If you could just help us understand what is the total volume share that Dalmia has broadly in states of Tamil Nadu, Kerala, because as we understand, pricing seems to be severely impacted there. If I'm not wrong, Chennai prices are now almost at par to Hyderabad. Usually they are 30, 40, 50 rupees higher. Also the gap between the Andhra players and the large players like you in the region has narrowed down considerably to just about 10, 15 rupees. Normally it is much higher. So how should one look at competition in these two markets? Is it fair to say that structurally now, while volume growth will continue, but pricing, this sort of a thing is the new normal here? Thank you.
One, we don't share specific market share number of any state, but at the same time, I think after some time, again, the prices should be better in South because it has seen such a low price on account of which for few companies these prices are not viable also.
Yeah, exactly. It's gone so low that it's unviable now for Andhra players to come into that market, which is great for us. But I think it also dents the profitability comparatively. In the past, these were high margin markets for us. So is that a fair thing to say that this is the new normal, as in profitability will be a little bit impacted, but volume continue?
No, it's not new normal, but things do change, and it's just not 1 quarter or 2 quarter decides whole thing. It's not new normal. Things should come back. Prices should come back.
Okay, thank you. Thank you so much.
Thank you. We have our next question from the line of Raghav Maheshwari from Asian Market Securities. Please go ahead.
Singhi, can you please share the number for the trade volume and the CC ratio for the Q4 FY23?
Last time it was 64% trade sales and CC ratio was 1.74.
Okay. And sir, what is the company's strategy for the Bhilai Babupur complex, which is the stake of the sale is also in that? What's our view on that?
I think let the deal get done and then we will talk to you about it. We think it's a attractive region that we are entering into, and I don't think we are going to give plant by plant strategy.
Okay, sir. Sir, last question is from my side. What is the realization drop? The primarily thing because of the higher infra demand in the non-trade segment, or there will be because of the primarily the lower prices of Tamil Nadu, Kerala this time on the sequential basis?
I would say lower prices of Tamil Nadu and that area also, as well as some part of East.
Okay, sir. Thank you.
Thank you. We have our next question from the line of Bhavin Cheda from Enam Holdings. Please go ahead.
Yeah, good morning, sir. Sir, in the initial opening remarks, you said we were looking at 14-15% volume growth. I assume that includes JP assets volume in your volume, which you will be contracting?
No, please.
Sorry?
No, please.
That will be an addition.
That will be an addition. So basically, organic, you are looking at 14-15%, and whatever you plan to get it from JP, that would be over and above that number.
Yes, I said about 15 to 17%, yes.
15 to 17%. Sorry, 15 to 17% is your organic, and over and above that, contracting volumes.
Maybe.
Sure. Second, we are not though sharing the JP volumes, but can you roughly share what would have been a cost or EBITDA impact due to contracting volumes of Jai Prakash? in order to understand how we will benefit in future as the Jayaprakash volumes, operational efficiency improves over future? Any ballpark number in percentage term, rupees per number you would like to share?
So presently, we would not be able to share these numbers because it's just the activities we have started.
Right. Because on the higher volumes, your EBITDA per ton has given a negative surprise in this quarter, and I'm assuming this would have partly been because of the contracting volumes of Jayaprakash. So it has a lot of sensitivity when we try to compare it with peers. So any clarity on the same would be highly appreciated.
There's not major impact on account of that part. This is what I can say.
Sure. Thanks a lot, sir. Thanks a lot. Yeah.
Thank you.
Thank you. We have our next question from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity, sir. So one question on the Bhilai JP, that acquisition. So with regard to that, like, is it required that the clinker should be sourced from that Babupur clinker unit? And secondly, how much dues we need to pay? Like, say, I believe 500 to 600 crore odd dues are there, which are to be paid by this unit to sell for the slab. So is this 666 crore, the acquisition price, includes those? And secondly, on the clinker supply, is it required to have the supply from the Babupur clinker unit?
So like we have said that we would be sharing the details once we complete this deal. But otherwise, we had already shared that is...
this acquisition price is on a zero working capital basis. So if any negative working capital is there, that has to be subtracted.
Okay. And if any dues, those dues, would those need to be paid over and above the 666 crore or not?
No, as I said, it is on zero debt and zero working capital.
And secondly, with regard to that Babupur clinker unit, would that grinding unit need to be sold only the clinker through Babupur, or you can supply it from other clinker units, like say Super Dala or anything?
So all these details we will be able to share once we conclude the deal, and then we can share our strategy that what it is.
Thanks a lot.
Thank you. We'll take our last question from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good morning.
Sir, we are not unable to hear you.
Am I audible now?
No, sir. Can you use your handset mode, please?
Is this better?
Can you speak again?
Is this better?
Sir, are you able to hear him?
It's quite low.
Speak louder.
Hello.
Not able to hear.
Mr. Jain?
Hello. Yeah, am I audible now? I'm using
better.
Yeah. So, sir, my question was on the volume growth. If I look at the last, let's say 4-5 years, we have grown our capacity, from 25 million tons to 40 million tons, which is, let's say, 50-60% capacity growth. But our volume growth in the same period has, lagged quite substantially. Right? We used to sell 17-18 million tons in 2018-19. Today we are doing 24-25 million tons. And in this period, we have also went into newer regions like, West and all. So what is, let's say, 2-year, 3-year outlook in terms of, growth? Because now again, we are looking to add capacity in Northeast, where, I see merit in North is growing faster, but we have substantial excess even today. So let's say from a 2-3 year perspective, what kind of volume target or utilization number, anything you want to comment on that?
So one, I would say that we have grown better than the industry in last 3 years also, and at the same time, for FY24 also, our growth would be what the growth would be of industry leaders, and we would also be growing higher than the overall India average.
Right.
Thank you.
Thank you. I would now like to hand the conference over to Mr. Puneet Dalmia for closing comments.
Thank you very much. I really appreciate all of you taking time to join this call, and thank you for your support as always. Have a great day.
Thank you.
Thanks, everyone.
On behalf of Dalmia Bharat Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.